Hey folks, what's going on? We're running a couple minutes late. Maybe one day I'll get this Zoom thing right. Hope you guys are doing well. Hope you guys are having a great week. Doing a Zoom review today. So as usual, you guys know you guys usually get the market reviews the days I'm not live. Normally I'll do a market review for you guys to give you a review for back testing, for editing, or for not editing, just a lot of business conversation today. So actually, hopefully looking to get some rest tomorrow. For logging, journaling, right? Because if you don't have the skill set where you can constantly predict these setups, how do you get to the point of doing what you see me doing every day, which you see my analysts, my team of analysts calling out to you guys? How do you get to the point of actually predicting that, right? And not having to guess, not having to resort to, well, I think it's my model, or having to copy somebody else for the rest of your trading career, right? How do you get to that point of understanding how to find these setups independently? You have to do what I'm about to show you here, which is reviewing the charts every day, right? Studying your model, looking at the charts top down, because if you're not doing that, you're not even giving yourself a chance to get this, right? And I'm someone who's very straightforward because I'm willing to work with people that want to get successful. A lot of people don't have the right mindset, and I don't have any time for that, which is why I remind you guys every single day. It's absolutely possible. You can make a shitload of money with your trading, but you absolutely have to do the right things as well, right? That's what I'm here to show you guys how to do. So appreciate you guys joining us here today. Let me get this down. My team always says it looks better when it's blacked out in the office. So let me get the screen down. So let's start the screen share. For those of you guys that are, hello, Leon. Hope you're doing good, brother. For those of you guys that are in the community, I know many of you guys may be to and from work. We train several people who are in university, running businesses, working full-time jobs. And we, of course, like to make these resources available for you guys to review at your own convenience. So within the community, it'll be in the market review tab for you guys to review at your own convenience. For the free community, hopefully you're here. Hopefully you have your notepad ready because we're about to dive into it. So I hope you guys are having an awesome day. Hope you guys are staying safe here at this non-farm payroll. And hopefully you guys are ready to learn. Let's get to it. All right, let's get this business here sorted out. All right, so we're just going to go ahead and take it from the top today. Not going to have any annotations ready, and we'll just start from the top. So what I'm going to start today's with, I was getting a lot of questions, especially from the newer folks in the community, around how we were able to just absolutely walk price on a leash yesterday and today. For some of you guys, it's new actually seeing that level of precision. It's nothing new for us, and obviously those that have been here for the entire year. So I want to go into how do we do that? How are you, more importantly, going to be able to do this as well? So I want to touch on top-down analysis, right? These are all the components that go into the callouts you see me doing, callouts that you guys got real time today from one of the analysts that's on my team that has worked with me for years. And it's absolutely possible for, again, you guys to reach that skill set as well. But how do we do that? Let's get into it. So we want to start from the daily chart. As always, I'm going to take off today's daily candle because what I'm going to be reviewing is yesterday's price action. And then from there, I'll go into a brief review of what we saw today, make it an insightful one for you guys. And then from there, I'll go into some Q&A. So hopefully you guys brought me some good questions, trades to review, whatever the case may be, hang out with the community for a bit, and then get back to enjoying the rest of my non-farm payroll week. Hopefully you guys can see, not the cleanest action. Obviously able to sort it out today, but that's why I'm very content on on-farm payroll weeks, getting paid on Monday, being in cash, and being content for the rest of the week until we get to non-farm payroll Friday. Right? Again, we show you guys the strategies that make us consistent, that make us money month over month. And then it's up to you to take what works for you, what doesn't, and make your own trading style and trading model with all the tools that we're teaching. And obviously we teach over live price action, not in hindsight or any of that. So for those of you guys that may have not been in the live stream yesterday or have seen the call outs that Tommy was doing real time this morning, rest assured that everything I'm reviewing here was anticipated beforehand, and there's no hindsight, none of that stuff. All right, so let's get into it. Daily chart for Tuesday's candle. Really nice delivery here, expanding out of the range and taking out the buy side liquidity. And that all starts from the weekly time frame, right? Because on the weekly chart, we're doing what? What have I been saying the entire really month of October and September? I'm not trying to call a top in this market, meaning the bias is bullish. It has been neutral to bullish because we have been in a consolidation, but the bias has been bullish because of the weekly and daily chart. And I always emphasize that's not something I'm trying to stand in the way of, right? I'm trying to stay in line with that and stay with the higher time frame institutional order flow. And you can see weekly candles, although very sloppy, a lot of back and forth, it's still doing what? Pressing higher, pressing higher. And that's the entire purpose of a weekly buy, is to know where you want to frame your setups in the direction of. Makes sense? And if you have any questions as I'm explaining this, for those of you guys that have already been in the community the entire year, this will just be an easy review for you guys. Same thing we do every day live and that you've been taught throughout the entire year. For those of you guys that are new, I'm sure a lot of this may even go over your heads or it may be new for you. If that's the case, don't worry. Show up when these resources are made available and you'll get to the point of learning how to do it all on your own, which is, again, what it is that we do this for. So daily time frame, looking at the key levels we were working with here, we had a fair value gap yesterday. Right? So again, what am I doing on the daily chart? If you watch the free video I did on top-down analysis, you know, on the daily time frame, what are we looking to do? We're looking to sort out our key levels and have a daily bias. How am I able to keep my charts relatively clean? And when I say relatively clean, that's all relative, but clean in the sense that it's not confusion. Because again, one of the biggest struggles of many ICT traders and many I've coached, and even myself early on, which is, man, what the hell do I do with all these levels? Especially as you learn more levels, more pieces of the puzzle of how it all comes together, it can become really difficult to manage if you don't know how to. So that's why every single day I'm live, every single time when I'm doing these reviews, I'm showing you how I know what PD arrays to work with. So that over time, when you're doing your own analysis, right, when you're trading for yourself, you're able to do these things again entirely on your own, just like you see myself and my team do every single day for you guys. So daily time frame, this is the daily fair value gap below market price. And we're looking for higher prices, right? Yesterday, I did not, especially in the morning session, anticipate that the market would get all the way up into the previous week's high, which is this level here, but it did. And I'll tell you what signatures told us the market was leaving a consolidation and how we're going to take out that high. But what you want to study, right? Because you're going to see when we go into the 5 minute and 1 minute, and you're going to see how we map out the low of the day, how we know that's the low of the day, and then how we just call higher prices from there. And it's very straightforward. But it's not straightforward if you just go to the 1 minute chart. What you want to start studying on your daily time frame is open, low, high, close. What time is it making the low of the day? What price is it making the low of the day at? Time and price. What time are we making the high of the day? Interesting. 9:30 makes the low of the day, and we expect the high of the day to form between 3 to 4 o'clock. Vice versa if it's bearish. That can go right in your notes. So we look for a low of the day from 9:30 to 10, and then the high of the day is going to form 3 to 4 in the last hour. Very straightforward time and price protocols, because again, if smart money central banks are in here trading, they're not doing it on guesswork, right? They're doing it on very specific algorithmic principles that deliver every single day. So we see we open, we have a low inside of a daily fair value gap, and then it makes the high of the day to key price. So low and high, study what time are these levels being made on your lower time frame. This is how you avoid being a pattern trader on a 1 minute time frame. Right? Oh, well, 1 minute fair value gap shifted short. Why didn't that work for me? Well, look at your daily chart. What's the daily chart doing? And you're going to see why you want to trust buy models. And not to say there's not scalps, because in a bullish day, there's absolutely short setups to be taken. But where's the highest probability trades going to be taken in line with this daily and weekly candlestick, right? So these are the things we want to look at on the daily chart. Where does it make the low? Where does it make the high? Let's keep it rolling. Hourly time frame. And this is, I'm going to go through the lengths of doing this. Normally, I don't do this myself unless I'm journaling, but these are things you want to be doing. You want to label your liquidity, right? So this is buy side liquidity. This is the previous week's high. Because if it's an algorithm that's delivering price, it has to know what highs and lows is it can refer to. And it's highs and lows that form a specific time, right? So previous week's high is an important liquidity pool, and previous day's high is an important liquidity pool. And again, these are consistent things that we use every single day. So if you're new, I can see how right away this is a lot of stuff to keep in mind. But it's really not that much when you work with it for months. And then you journal it and you study these things like I'm showing you right now. And over time, it'll actually get very simple for you because the things that repeat again are very consistent. So now then let's put day dividers on. I always like to know what 24-hour period I'm working within. So we have Monday, midnight, and Tuesday, midnight. This answers a lot of questions. I get asked, how do you back test? How do you journal every single day? This is what you should be doing, right? And it takes about anywhere from 45 minutes to an hour. Many that started with me at the beginning of the year that are seeing results, are seeing consistency, did this work. Those that are still maybe struggling or maybe haven't seen the results they want yet, it's because we're not doing this right here, right? So there is no secret, but there is a way to do this the right way and learn quicker, right? So we see Monday's trading here, Tuesday's trading here. This is the new week opening gap. This is an important level that you'll want to have. I'm not going to have it on my chart just to keep it clean, because now I want to look at time and price, right? So remember what that daily candlestick looked like, right? And then as we go into the lower time frames, I want you to still visualize what that daily candlestick looks like, because now this is what you've been missing. And this is why you're looking for patterns as opposed to bias and narrative through top-down analysis. Because as I go into the hourly, right, the 15-minute, the 5-minute, the 1-minute, it's all going to be subordinate to the daily chart, the weekly chart, right? So keep in mind the daily candlestick as we're going through this review. Here we have midnight. Midnight opens a key level. Why? Because if smart money wants to buy a discount, if you knew the daily candlestick was going to be open, low, high, close, where would you want to buy? You'd want to buy below that opening inside the wick of the daily candle. What time is that low of the day form? 9:30. What time does the high of the day form? Right on schedule, 4 o'clock. 3:24. Market drops down. We take out a sell side liquidity pool here, which is a low, right? And what we understand about smart money is, let's say they have the intention of taking it higher into these equal highs. But how's that going to be delivered? Because they try to hide the narrative. The narrative is it's bullish. Are they just going to send it straight up? No. They need to drop it into a discount. Why? So that they can buy a discount and then sell it up here in a premium. So very simple stuff that we're focused on. Discount to premium. The market runs from sell stops to buy stops. And it does it on a scheduled delivery. How great, right? So the market drops down below sell side and below the midnight open. Who's buying there? Smart money. That's when we're hunting the Judas swing at 9:30. So that's why when I'm watching the market trade below this low and we're live, I'm expressing to you guys, okay, I'm studying how we trade below this low, because I have all these things in mind. But imagine me trying to explain it in, in these 1-minute candles as it's happening within 15 to 30 minutes. But this is what I'm looking at. This is what allows me to trust and call these levels to you guys. So what do they do here? They drop it below sell side. But what do they leave up here? Smooth highs, right? Equal high here. That's relatively equal to this one. So now look at how they set the stage. They leave equal highs. What does retail see there? Oh, resistance. Oh, it's going to drop. And then at 9:30, they give them a violent run lower. And you'll see the same thing happen today, right? How was my associate Tommy able to call higher prices after that violent 9:30 Judas swing? Oh, shit, man. It all comes together. It does, right? So it drops at 9:30 below sell side and midnight open. But what do? They leave equal highs here. What does that do? That sells the idea to retail that, oh, it's resistance. Look, we're going to drop. Retail's looking for shorts. They're chasing the run lower. Smart money is expecting open low, high, close on a scheduled delivery. Buying sell side. If you're buying here, where would they want to sell it? Obviously more expensive, but if you want to sell something, you need a buyer. How do they engineer buyers? Well, when they drop it here, they're engineering buy stops here. People that want to have a buy stop to protect them on a short, but also people that want to buy on a breakout. You see how that works? Relatively equal highs here. They drop it. What does that do? It sells the idea of resistance, or that the market look once, twice, there's that double top pattern and now it's dropping, or it's a demand zone. And all that is with the express purpose of engineering counterparty for them to buy down here and then sell it here at the high of the day when we expect the high to form, 3 o'clock to 4 o'clock. And if that's something you study every single day, your jaw will hit the floor with how precise this is. So 15-minute time frame. And again, you still want to keep in mind the daily chart. Open low, high close. And now all of a sudden that 15-minute chart, that 5-minute chart, that 1-minute chart, now it makes a whole lot more sense. And we're not just going to be chasing patterns and fair value gaps everywhere. We're looking for a very specific narrative. And then once we have that, we're attacking because we know what we're looking for. So let's look at this on the 15-minute chart and get some more refinement here. Midnight open, they send it higher. What does that do? That builds sell side here, right? Because people are buying and chasing that move higher, and they're putting what? A sell stop here. So anyone that goes long early that doesn't understand time and price, that we look for a low of the day to form at when? 9:30. Because this is the Judas swing of the daily range, right? So if we're looking for higher prices for the AM session, what are they going to do first? They need to drop it first. Why? Because then that allows smart money to buy a discount. And then where are they going to distribute it? Remember those equal highs here and here? So that's why this was such an easy draw for us this morning. This here was the bonus round. And I want to share how we could have then anticipated the market would keep expanding. And actually, I'll just touch on that now since I'm already talking about it. New week opening gap, as long as we were at that level, we're in a consolidation. So one of the things that I was sharing was we took out sell side. The easy run right now is the run into the buy side. And from that low to high, that gives you over 128 9 handles to work with. I'm not saying anybody bought the bottom and sold the high and made all those 129 handles. But now what you can do is study this price range from here to here and study your 5-minute chart, your 1-minute chart, your 15-second chart, and watch the world of opportunities that's going to open up for you with just something as simple as sell side to buy side. And you don't even need the daily bias and all this up here. But you guys know me. I'm going to show you how to even get that as well. But what's exciting for even a developing trader is, let's say you don't know all these things about the daily range. You don't know open, low, high, close, and all these factors here. You can pay yourself with a very simple model. Market runs the sell side at time, and then it runs to where the highs are smooth at time. And you don't even need a daily bias for that. That's the model I taught for free in the webinar. So you see how all this comes together, and it's not complicated, but you do have to study and apply yourself to do it at a high level. So let's look at this here. Sell side here engineered ahead of 9:30. At 9:30, they sink it. What that does is that gets retail Ricks one into short because they don't know what they're looking for. They're just chasing the market up or down, whatever it's doing. We know exactly what we're looking for. So we expect this here. And then once it takes out the lows, we study how does it trade below the lows. Smart money is buying here. More advanced traders are able to take that turtle soup. What do we want to see if that's not your model? We want to see these lows rejected to the upside, right? Does it? Yes. And then you would look for a 1-minute fair value gap, a 5-minute fair value gap, a 1-minute inversion fair value gap, right? Many guys trade that model. A bullish breaker with a fair value gap, institutional order flow entry drill, a bullish order block. They all work when you understand these components. So smart money's buying here, but the good thing is you don't even need that. You just need to anticipate this and then see it reject. Additional insight, since I got people that have been working with me for the whole year here. What additional insight told us this market was really strong? Well, let's measure this wick here from low to high. What does the market do? Trades down, can't even hit 50% of that wick. That tells us what? It's not just going to trade higher, but it's really bullish. Market expands, consolidates in the lunch hour, and then we make the high of the day from 3 to 4 p.m. when we expect it at price. So keep in mind, it's not just time. It's not just, okay, well, let me just look for a random higher low to form from 3 to 4. It's time and price. So it's 3 to 4, but what price would we look at? Previous day's high. That's a liquidity pool we work with every single day. And previous week's high. Very key liquidity pool algorithmically. Because anyone that's short, where's their stops? Here and here. So at 9:30, the market drops. Trades down, can't even get to 50% of that wick. Down close candle supports price, expands higher. We get a consolidation during the lunch hour, and then expansion to the upside. Sell side to buy side within the daily candle power of 3. So let me take this off now. I think that point's been emphasized. Now let's drop down to the 5-minute time frame. So again, 9:30 open here. Let me get this back over here. We'll focus on the AM session, and then I'll go into some insights for the PM session. Because I know my man Tommy was sharing in the Profits channel that he was banking on that run in the afternoon. And as always, I want you guys to know exactly what we were looking at and how we're able to anticipate these things. So at 9:30, they just sink it. Aggressive repricing at 9:30. What that does is traders that don't really know what they're looking for, they get to the 9:30 opening bell and they just freeze up. because they don't know what they're looking for. We don't have context, and it's not a knock. That's genuinely what retail traders are doing. That's why the market does this. If everyone was a winner, who would be taking money from who? It doesn't work like that. So the market has to engineer losers. And if you understand how they do it, then that gives you the ATM machine, right? So at 9:30, what do? They sink it, and they do it violently. Look at how from this high in 5 minutes, whoops, in 5 minutes, they sink it 94 handles. Below what? Oh, look, there's a low, there's equal low. Man, that's strong support. Support's been broken. It's time to go short. Or they chase the move and sell the breakdown. Or equal lows here, they're buying. Where's their sell stop? Here and here. That's all perfect sell side liquidity for smart money to buy. And then do what? Distribute it to the equal highs here and here. And then if you see these highs are taken out, what do you have to do? You zoom out to a higher time frame. Because if it takes out the buy side inside the parameters you're looking for on like a 15 or a 5-minute chart, and it keeps ripping higher, the algorithm's telling you it's reaching for a pool of liquidity on a higher time frame. So zoom out. Then what do you have? Well, on the hourly time frame, if it's not just going to run for the equal highs here, where's it going to go to? The equal highs further outside of the scope of this range here. Back to the 5-minute. They sink it at 9:30. If you've been with me for any length of time, we never chase that run there. We expect it. And then we do what? We study how do we trade below the lows. And you see how it spends 1 candle, 2 candles, 3 candles there? That's not really 15 minutes because it had to get there and then leave it, but it at least spends 10 minutes there. What is that doing? Well, see, smart money entities, they can't get their volume in the market on a 1-minute, 2-minute candle or in 2 minutes. They have lots of orders they're putting through. So when they drop it, you'll see what this looks like. Let me just show you on a 1-minute chart real quick. You see how they hold it down here? So the whole time the market's spending time down here, we're watching this like, okay, we want to see how we trade there. Is it going to continue to accumulate and then send it higher? What's retail seeing? Support broken. And now they're seeing one of those bear flag patterns to go lower. We're looking at this like they're dropping it, not a bear flag, but they're accumulating below the low, below the key 15-minute sell side, and also below what's that purple level? Midnight open. They want to buy below the opening price in the wick of that daily candlestick. How do they do that? Well, they buy sell stops and they do it below the midnight open. It's very simple what they're doing. So let's go back to the 5-minute chart. They sink it at 9:30, accumulate the sell stops, and then we do it. We trade higher. What's this? Your breaker. Right? So many people like to trade the breaker pattern. Why does it work here? Because of context, not the pattern itself, right? On a 1-minute, 15-second, like I was sharing here, how do you backtest? Well, you study this run from here to here into the highs, and you study in that 128 handle run, what makes sense to you? The fair value gap? Is it the breaker? Is it inversion fair value gap? Whatever your model is, they all form and they all work when you have real narrative and top-down analysis behind you. So there's a breaker. Market takes out the stops, shifts market structure. Right? Support, and then expands into the buy stops that we were looking for real time yesterday with these equal highs here. You can also use the down close candle here as a bullish order block, or you can use any lower time frame inefficiency to go long, and they all work within this context here. Right? So again, I never emphasize the pattern or the entry model you use because it's actually the least important thing. You could have the worst entry here. I mean, you could literally buy a retail strategy. You could buy the breakout here and still make money. So the entry is not important. It's understanding how to read the market, understand where it's going, why is it going there, how is it communicating to you that the damage has been done, and now what? These highs are smooth here, and these highs are smooth here. Where's it going to go? Right? These are the easy setups that I train my team of analysts to look for, and those that are learning to trade with me, this is what we look for, right? These easy one-sided setups where you can't justify lower prices, and it's easy to see these runs there. So now let's take it one step further. We have the lunch macro of the day, which is from 11:30. to 1:30. So this is a 2-hour period, which many times people say lunch hour. The lunch hour is actually a 2-hour period from 11:30 to 1:30. What we expect in this hour is a stop run. A stop run on what? On the move that's been profitable for the morning. So what you want to look at in 11:30 to 1:30 is you want to find where's the most obvious low that forms after 10 o'clock. And that's going to be this obvious low right here. Why does the market do that? Great question. That's because if smart money, if they're looking at open, low, high, close on the daily candlestick, like we started the stream off with, what are they expecting in the PM session? A continuation. Because if it's going to be open, low, high, close, and close near the high of the day, what's that implying about the AM and the PM session? It's implying that the PM session is going to continue what the AM session has already done. You see how just all that comes together very nicely? So all these concepts merge together seamlessly when you understand how it all applies. So now let's play devil's advocate here, right? Smart money knows it's likely to trade higher. What time do we look for the high of the day? 3 to 4. Very straightforward stuff we've been doing all year long. But before that expansion, just like here, smart money has to do it. They have to get into a position. Well, how do they get into a position? They have to buy sell stops. So they drop it at 9:30. That allows smart money accumulation. But what allows accumulation for that next leg higher? They drop it here below the most obvious low at time, 11:30 to 1:30, when we look for the lunch macro. And now they're going to buy here for the next leg higher. Why would they be buying there? Well, think of what's been happening in the morning session. Who's been making money? Folks that are going long. So if folks are going long, where do they protect a long position with? A sell stop. Why are they going to put the sell stop? Well, where do the books tell them? Where's the most obvious low in the market? Right here. So they're going to do what? They're going to jam up their stop because they don't know what they're looking for. They're fearfully moving up because they're in profit. They don't want to lose that profit. So where are they going to put that stop? Right here. Smart money buys that stop at the time they're looking for it for the continuation in the PM section. So you see how these factors here allow us to trust the market's going to keep expanding higher. So when my man Tommy's saying that he's banking in the PM session, what's behind that? Well, what was the bias I gave you guys yesterday morning when we're live streaming all this? Bullish, higher prices. So if the PM session does this, then what do we look for? A continuation. Where's it going to go to? The obvious previous day's high, previous week's high, all key algorithmic levels because it's time-based liquidity. So let's drop down to the 1-minute time frame. Already going on a bit longer than I wanted, and I'm also going to review today. So then you guys are like, oh, don't stop. It's all right. I got things to do today. So let me keep this one moving here. All right. So now let's look at the 1-minute time frame. And again, I'm going to urge you, let me get the charger on here. Screen sharing is stopped because your external display has been disconnected. Well, let's fix that. All right, should be good to go. All right, sweet. All right, so what 1-minute time frame? Again, before I go into the 1 minute, I want to constantly reemphasize this because I can't hit this point home enough. Even traders that I've been working with for the entire year, one of the biggest things that we still talk about is top-down, higher time frame. It's really, really easy to get sucked into these lower time frames and see all these movements, and it's so easy to lose the plot. The way you avoid that is you keep in mind what I'm saying is, I know I keep reemphasizing it, but what's the daily candlestick? It's bullish and it's open low, high close. And then we look for all those things to happen at the right time of day. So again, I want to emphasize that because I know a lot of times it's really easy to get sucked into, man, what's Tommy and Dylan doing on the 1-minute time frame or the 5-minute? And I guarantee you, it's not even that. It's how all these things come together that give you this precision that you know exactly what you're looking for. And folks that you guys see even taking the same trades as us before we even call it, or maybe they're not with us, they're taking these trades independently. It's because they've done this work every single day of journaling, logging, and it's boring. It's hard work. But I never said financial freedom would be easy. It is possible, though. 1-minute time frame at 9:30. They sink it lower. What do they leave? All these equal highs here. Right? So they do shoot it higher initially above these equal highs here. What that does is that gets people to buy it early. Because people, a lot of times, a lot of folks, and I know maybe you guys don't trade like this, but many folks do. They just get on at 9:30 and they just chase whatever happens. So when they see at 9:30, this is a blue candle, they're just trying to buy it. So what that does is this gets in early longs and stops them out. If you bought here and you get this type of stop out, you're demoralized. You're not going back in long. That's what this is designed to do. So at 9:30, when we're bullish, and again, keep in mind what these reference points are, right? That's that liquidity on the hourly and 15-minute chart. They drop it below sell side here and here and the midnight open at what time? 9:30. So at 9:30, they sink it. That does two things. Anyone that's long, they're stopped out. Or anyone that wants to go short is now short. And then they even give them a bear flag where they're accumulating long positions here. What do we want to see below the low to confirm it's good? What's one of the signatures that we always look for in our trading? A displacement, right? We want to see it displace away from this low and get away from it quickly. Because what that's going to indicate to us is that now they've trapped traders short, and now they're ready to take it in the opposing direction quickly so that they can distribute the long positions they accumulated here. What's up with this blue rectangle? Thought I forgot about that. Let's go up to the daily time frame. Let me show you why that's a level we're using and why we're even concerned with that level. This blue rectangle is, again, this daily fair value gap. Turn on Do Not Disturb. Sorry, remember, I always have that on already. Apologize for that. Daily fair value gap. This candle's high with this body here. Normally, you may look at the fair value gap as having to be here at that wick, but because there's a volume imbalance here, right, where the bodies aren't touching, that tells us we have to use the entire imbalance. So now, the daily candlestick, we've already talked about. We started here, open, low, high, close. Lovely. But now let's look at this fair value gap in the lower time frame. You guys can really see where the magic happens. $9.30, they sink it. What's this blue rectangle, the daily fair value gap? Like I tell you guys, I like to keep my charts clean. I don't like too much on it outside of daily levels. And then obviously I have several other templates across my array of monitors that I look at: new week opening gap, regular trading hours gap. But like I said, this can easily go on about 3 to 4 hours. And if you know me, you know, I can keep teaching until blue in the face. I still want to keep this refined. Those would be entirely different lessons if you want to learn all those things, but this is more than enough for someone that's just looking for a model, looking for consistency, and wants to understand more what top-down analysis really is. At 9:30, the market drops below sell side. And then what do we want to see from that sell side? A displacement. That confirms to us that, yes, institutional players were buying here, and that's confirmed by the displacement. Their buying pressure isn't sending it higher. It's the fact that they're in alignment with the algorithm that the market displaces away. So I want to clear that up. It's not the buying pressure. So looking at this daily fair value gap, let me go ahead and label that. So this is what you would want to do in your back testing, right? You wouldn't want to just have a blue box on there that you're not going to know what it is. You're going to want to label it. So you would do that with call it 32 daily FEG. This is the sell side we were looking at, or the buy side we were looking at rather. So we'll put that on the right, because when you're doing your screenshots for your journal and you're studying how these things deliver every day, and wait till I get, well, actually, I'll just touch on that right now. Same thing today, right? My colleague gave you a bullish bias. What happened at 9:30? Oh, shit. Man, this repeats. Oh, yeah. Get back to what I was saying. So let's go to, yeah, that's good. All right, let's scrub back here. Whoops, I actually want to be over here. All right, so let's scrub back here. Because for those of you guys that are new in the community, I'm sure you guys were asking me about the wizardry that we did live yesterday, and then obviously how my associate walked the market for you guys today. And that's in the free portion of the community, man. It's better than most paid discords. So let's go into the daily fair value gap here and zoom in with what's going on. So at 9:30, they sink it to the low end of that daily fair value gap. If we're looking at time and price, we want to see a low of the day form after 9:30 at a key daily level and sell side. They drop it, accumulate it, it displaces away. That confirms us what the market's bullish. If you've been with me for any length of time, you know gap theory is something we use every single day. What is gap theory? Gap theory is using imbalances to understand order flow, use them as entries, exits, again, means of seeing market structure. So one of the basic tenets to gap theory is if we're bullish and there's a gap, we want to see the market get above the gap and preferably stay in the upper portion. But that's going to happen after we see the market do what we need to do first, which is what? Accumulate retail trader stop losses and take them out of the move. So first we look for the sell side here and here, because you may be looking at it, well, you expect it to stay in the upper portion. Well, it just melted through it here. Well, the market's doing what? It's getting sell side. But once that sell side's taken, and now it displaces higher, that's your trigger. That's your green light that we're going higher. Where's it going to go? The obvious equal highs. And the 930 high. Because any retail trader that chases this short, where's their buy stop? Right there. Which is why this was first target yesterday. And this was the best case target here on the 15-minute liquidity pool. So let's zoom back down here into this business here. Daily fair value gap, it displaces, that's our trigger. Now we look for what? Discount levels to support price. Because that's going to tell us what? Order flow is bullish. So the market does what? It retraces into this range from low to high, and it trades into a short-term discount. What else is here? Well, we have this fair value gap here, which it trades into and hits. But what else do we have there? The daily fair value gap, consequent encroachment. So you start to see here now how the bodies are what? Stopping at that dotted line. When if we're bullish, we want to see what? The market stay in the upper 50% of this daily fair value gap, because that's going to tell us what? Institutional order flow is very bullish. And then what does it do from here? What do we want to see? Displacement away quickly. It shouldn't mess around. It should get up there, because what's happened now? Now there's buy side here, and they're relatively equal. There's traders that are trying to short that. Where's their buy stop? Up here. So they're going to be in a hurry to clean them out. So it retraces to what? Daily fair value gap level. 1 minute fair value gap. And then we expand higher. So when we're watching this live, and I'm telling you guys this first presentation fair value gap, which is the first fair value gap of the session. Here. Once it's above that, that's a long for me. I wasn't trading yesterday because you guys know my protocols. I'm here to get paid, not impress. I'm impressed enough when my bank account's increasing every month. But once I get paid on Mondays, I'm not trading. But I'm still going to do what? Come out here live with you guys to sort out the price action. So why would this fair value gap here be a long? Because I'm reading into all these things. We've already dropped down into a discount. Daily fair value gap showed support. So now when we get back above this fair value gap, that's a valid long entry. What was the targets I gave? Buy side here, that's a 37 handle run. And then the best case target is a 70 handle run. And that's fairly decent for an on-farm payroll week, especially ahead of the numbers, especially with the election going on. So if you're in here carving out your 70 handles, that's a very good day, right? Don't let social media or whatever try to convince you that, oh, you need 100, 150 handles, because with 70 handles, you can do a whole lot with that. And that's not even understanding the whole daily range here. Hits the fair value gap, we expand, down close candles, trades down into it, supports price. With the fair value gap here, trades into at 10 o'clock. That's the silver bullet long. Trades down close candle, support price, down close candle here. If the draw's up here, what tells us it's going to get there? Just like Pac-Man, right? It's coded. It has to stay within certain boundaries. So what does it do? It needs to respect what? Down close candles. Down close candles, support. Down close candles, support. Down close candles, support, all the way up into our targets. And that's how we walk the market day by day. But it's not the 1 minute chart, right? It's all these other factors that then on the 1 minute chart, you get crazy precision. Your inversion fair value gaps work. Your breaker and your fair value gaps work. Your order blocks, all those levels that you're looking for are very effective when all these factors come together. Let's move right along. I'm already a bit behind on time here. Lunch hour macro, 11:30 to 1:30. We expect the market to do what? Take out an obvious low right here. The market sinks down into that low. If we're bullish, what do we want to see? What's been the theme today? Displacement. What tells us this thing is bullish and it's going to keep reaching higher, right? Again, you have to keep in mind the higher time frame. So again, don't get lost on the 1 minute. What would the market be reaching for? Equal highs on the hourly time frame. So when we see these lines here, let me put them all the way to the right so you guys can see them while we're in the 1 minute. All right, these aren't just lines on the chart. These are key levels the algorithm's going to trade up to. So when we have previous day's high and previous week's high here, and we're expecting it to draw up into that, well, we expect the lunch hour macro to run back on stops. But then just like down here, so these things can be scheduled, right? These manipulation moves are scheduled. It drops at 9:30. We want to see that. below a key low, and it drops below a key low here within this macro window. That allows smart money to strategically buy, because what does retail see here? This time, it's not a double top, it's a triple top. So now we got a triple top here. Once, twice, three times, and then it sells off. So do what? They're chasing this move lower. Smart money is doing what? They're buying the sell stops inside the lunch hour to get the expansion into previous day's high and then previous week's high here. So they run the stops, but this does two things. It doesn't just allow them to accumulate, but it also engineers buy stops here. Anyone that's short, seeing this as resistance, their buy stop is going up here, or they want to buy on a breakout, which is all perfect for smart money who's buying here, wants to sell here, and sell here. They take it higher, they consolidate it going into the silver bullet 2 o'clock hour. And then from the consolidation, we leave the consolidation. Whenever the market leaves a consolidation, we want to see there be a breakaway gap. Why? Breakaway gaps can be anticipated. We do it all the time. But here's how you know why it's going to happen. When the market leaves a consolidation, or it's been consolidating, this is something I recommend to students all the time, because most try to get positioned in here. They're trying to trade their inversion fair value gaps, their order blocks, their breakers, and they get smoked in this. My biggest recommendation is wait for the market to displace. Why are you getting chopped up in this? Wait for it to leave the range, tell you it wants to leave, then trust your fair value gaps, inversion fair value gaps, your breakers. So don't try to push in this. It's not going anywhere. Wait for the market to leave the range. What range? Well, the high it's put in and the low. Because until we leave that range, it's just going to mark time and be time distortion. So you wait for what? What's the key word? Displacement. We get displacement here, we leave the range. A signature that we look for is we want to see that gap left open. Why? Because that's going to tell us it's really bullish to get up into previous week's high. Retraces and then runs up higher to clean out all the liquidity that would lie above that high. Making the high of the day at what time? 3 o'clock. 3 to 4 rather. So usually I don't do all these things, but because I want to reemphasize journaling, I've been getting a lot of questions on it. So you put last hour of trading. And how many weeks and months are you going to do these exercises for and see, oh, wow, there's the silver bullet. Why does the 2 o'clock to 3 o'clock silver bullet work so well? Because you're trading an expansion move into the last hour. And then you can understand the components of why your trade setups work, why it makes the high of the day at this time, why it makes the low of the day at this time. And that's walking you guys through an entire daily range. Low, consolidation and lunch and stop run, high of the day in the last hour. And this repeats consistently. So I also said I was going to review today's price action. Today's will be a bit more of a straightforward review. I don't want to be here too long. As much as I'm enjoying this with you guys, I do want to keep this more straightforward. So now let's take all these levels off and start again. So we have today's daily candle. Today it sunk lower, so it was a bearish day. However, just like in a bullish day, there's short setups that can be taken. The same thing with the bearish day. There's long setups that can be taken. It's just the easier setups are going to be in line with the daily buys. But again, with what we know, a daily bias isn't necessary. You just have to understand liquidity, how the market runs from highs to lows. And if you understand that, that's all you need for a trading model. But for those of you guys that have been live with us Monday and Tuesday and all those other days, what was the key level we've been watching this week? No, neither of those. The new week opening gap, right? In a consolidation week, we expect it to be referred to consistently. Today, sunk back down into what? The new week opening gap. Because if you guys recall, hold on, let me make sure I'm logged out of my brokers here. 1 second, let me get logged out there. Let me take all those drawings off. Perfect. All right. So if you guys recall, what 2 key levels have been extremely important this week? Well, if you recall, obviously, the new week opening gap is important, right? The current new week opening gap. That goes without being said. But remember the gem I gave you guys on Monday. if you have a clustered new week opening gap, meaning current new week opening gap and the new week opening gap from the previous week here, you see how those levels converge there? And remember, we had that Monday morning when we were looking for short setups here into the new week opening gap in here, because this is going to be like, this is what you want to screenshot in your journal. This is going to be a major magnet on price action. And you guys knew that before we even got the opening bell on Monday. And look at how the algorithm works towards it. What time did we make the low of the day on Monday? 3 o'clock, 3 to 4, how I teach it. And inside the new week opening gap that I gave you guys as a draw. That's all I gave you guys this day here, because that was the easy setup. The market running down into these key algorithmic levels. But look at where we got down to today. That's not random. And very nice delivery. So if you had those levels on your chart from Monday pre-market, then they served you well. And that also made the low of the day yesterday. We did the damage and give that setup, and that's something for your study there. But you see how screenshotting these things over time, and it doesn't take too long. I'm here doing it for 48 minutes with you guys. So not even a full 45 minutes, because I got on a few minutes late with a few technical issues. But if you take 45 minutes every day and you do this here, you will be a monster in 1 month, 2 months, 3 months. Maybe not profitable, because that requires a lot of self-discovery and a lot of personal growth. But you will be a monster at reading price action. So then once you learn self-control and how to read price like this, you're going to be a freaking monster if you do these things every day. And that's how we create monsters here. A straightforward recipe. So new week opening gap, that's why I'm taking your attention to that level. And look at where we made the low today, right? Not random at all. Hourly time frame. I'm going to look to keep this one a bit shorter here and get into the Q&A. I know I promised a Q&A, so I'll go ahead and get into that here quickly. So bearish day, working back down into the current new week opening gap. Again, in a consolidation week, that's going to be a key level. So it worked down into that here today. And that was the draw for the PM session. After noon on Wednesday, my team and myself, we cut trading off until after the news on Friday. So we're not worried about today's PM session, not worried about tomorrow's trading session, but nonetheless, it's still delivering what it's coded to do, right? So it's not like the algorithm's taking a day off or a vacation. It's just not going to be as precise as we'd want to see it be on normal days. So that's why we generally are more patient on those days. So let's break it down, drop down to the 15-minute here. And now let's look at time and price. So here we have 9:30. Immediately, we want to have what level on our chart for AM session trading? The regular trading hours gap, right? And what is that gap? I'm going to cover what that is. Let's make that, yeah, we'll make that pink. This is the opening range gap, right? The gap that forms from the settlement, the close on the previous day, and where we open at 9:30. That gap every single day in the AM session, you should have that on your charts. Monday, what gave us the easy trade? Where was Monday? Monday, right here, right? Why was the buy so easy for us on Monday? Well, one, we had the new week opening gap, but also look at the regular trading hours gap. We gapped what? Higher. So the gap's below. So what's it going to do? Want to draw into that. That's how we walked Monday on a leash. This is how my associate walked today on a leash. We called it, or he called it rather, lower. Into what? Into the hourly fair value gap. Right, so these are levels that we would be having on our charts from our pre-market analysis. And let me make that, let's look to do this one blue, because that's just a traditional fair value gap. So we're going to put FVG on here. Boom. Let's make that H1. And see, it's an hourly fair value gap. So hourly fair value gap, right? That's going to be a key level for us, because again, we mark out our levels top down. So because there's no real key daily level there, we'll work with the hourly one. So I'm going to take off this line off 9:30. You can see how the market sinks into that. That was given to you beforehand as a draw. It traded into that. But you're going to see what gave my associate the confidence to then look for higher prices back into that regular trading on the 15-minute time frame. Let's go back here. This is all a bit distracting, so I'm going to take off this price action here so we can just focus on the AM session. So keep in mind how we got the pink line, or the pink box rather, which is the regular trading, right? Where we open at 9:30, where we close on the previous day. This is a gap. If you're trading the morning session, you want to have this gap on your charts every single day. Let me go back to electronic trading and get this back on. All right. So we can see here, this is our opening range gap at 9:30. If we're bullish, and again, 9:30 is always going to be the low of the regular trading hours gap. So there's a couple of reasons why that price level is always important to be mindful of. So this is the 9:30 opening, which is also the low of the opening range gap. That's something that's always the case, right? Because the low of the, or the higher low of the opening range gap will be based off the 9:30 open. So at 9:30, if we're bullish, right, which the opening range gap sets the bias for the morning session generally. Not all the time, but generally. The market sinks at 9:30. Well, think about what you just learned about yesterday's session. If it's bullish, why would they do that? Who chases this run lower here? People that don't know what they're looking for and are in a hurry to gamble in the first few minutes of trading. So they sink it lower, get people doing like, oh, it's probably going lower. It's time to short it. It's time to look for lower prices. We expect that. We're looking higher. Tommy was giving you a bullish bias. And I'm able to speak interchangeably for him as well because we look at the same things. We are in lockstep in our trade. Not all the time we're looking at the same things, but for the most part we are. And that's what you'd expect with the transferable skill set, right? It's consistent. So multiple people should be able to do the same things as you guys see. Even folks in our Discord crushing it with the same logic as well. So the opening range gap acts as a draw. So the same way in which I shared the new week opening gap is going to act, the opening range gap will as well. So view it like a big magnet on price. But then you have to understand not just, okay, where's the magnet? But now you have to have things set up. If we're bullish, what do we want to see first? The market drop. Drop into either one of two things, liquidity or inefficiency. In this case, it drops down into the hourly inefficiency. And there's short-term liquidity here as well, but mainly the hourly inefficiency. So now we refine that to our 5-minute time frame. Get this back over here. They send it lower at 9:30. Again, that gets uninformed money chasing that because they're not really sure what they're looking for. So they see the market drop and they think it must be time to go short, right? They drop it into what? An hourly fair value gap, which is fair value for what? Why is it called a fair value gap? Fair value for smart money buying. Why would they buy here? Because they're going to sell it to the buy stops here. And again, as I always share, maybe you were looking for these highs here. But from this low to this high here, that gives you 156 handles to work with. Again, I'm not saying you're going to get the low to the high. But what I am saying is there's easy opportunity to get 20 points, 40 points, 60 points in this price run. And you don't even need all that here. And because it's the day ahead of, or 2 days ahead of NFP, we wouldn't be looking for home run trades anyway. We're looking to get in and get paid. And again, I always recommend this as advice. If you're green on non-farm payroll week, just stop. This is a week where most are blowing up entirely. So if you can actually be profitable and have the self-control to keep it, that's the key to becoming a profitable trader. So 9:30, send it lower, hourly fair value gap. Again, remember what I taught about gap theory, right? If we're bullish and we trade down into a gap, what do we want to see? Ideally, stay in the upper portion. It's even better if it leaves some of it open. See how it drops down and it stops right at consequent encroachment? What's the draw? Opening range gap after the 9:30 Judas. Because first, they have to get the public off sides. Again, the markets are a zero-sum game. If someone's making, they're taking it from somebody else. So they have to make it like this for smart money to take advantage of uninformed money that doesn't know what they're looking for. All right, 1-minute time frame, and look to get this one wrapped up here. I just want to touch on this trade setup here, and that's going to be it for me. 9:30, right? They sink it lower. This is a signature of a Judas swing. It's going to be fast, it's going to be violent, and it's going to be quick to get the levels. Why? Because they want to create excitement. Like they want to get people thinking, oh man, it's time to go short down here. And how else to do that except just sending it right at 9:30? And then what do they conveniently leave up here? Equal highs inside of the opening range gap. So when you put all this together, you're able to see why someone can see this fair value gap as a long into the regular trading hours gap here. Why we can predict this run from here to here is going to happen before the fact. So you can see why these things here are predictable. Why we can predict, okay, well, if we're bullish, first it's going to trade to the discount hourly fair value gap. Boom, nails it, predicting the future. And then we study, okay, now how does it trade down here? And then we give you trade setups. So now back to that here. We study, okay, how does it trade down in the discount hourly fair value gap? It accumulates, it displaces away from it, right? How do we know it's a displacement? Because it creates two fair value gaps on the way up. And then what do we know about gaps? The best ones aren't going to fill in. So if we want to see this thing trade higher and get into the regular trading, what are we looking and what are we reading into for institutional order flow? We want to see a gap left open. Does it? Yes. So as soon as it leaves that gap open, creates this fair value gap here, institutional order flow entry drill, and leaves it quickly, well, then it's really easy to see the market's going to trade up into these equal highs in the opening range gap because we look for these things. First fair value gap of the session, we use it to read order flow for that day, just like we'd use any other key level to read order flow. So what do we want to see here if we're expecting it to go higher? We are not looking at, we are not looking at this here as, oh, it's going to trade up into in short, right? He's saying we like the RTH along into the RTH gaps. That means buying to the regular trading. So while we're trading inside this gap, we're not thinking, oh man, this must be one of those short opportunities. No, we want to see it get above it. And this was called even before that. So this is what you're studying. If you've been with me for any length of time and you see us do this every day, then you guys already know what we're looking for. This is more for the newer folks that may just be getting adjusted to precision and what it is that high-level traders are doing. Initial fair value gap, we do what? We close above it. We want to see that. If we're bullish, we don't want to see it hit that fair value gap and sell off. We want to see it get above it with strength. It does. And then what do we have here? A fair value gap, right? Well, what do we know about fair value gaps? What I share about gap theory. If we're bullish, we want to see what? A gap find support at consequent encroachment and ideally not be able to fill the lower end of the gap. It drops into it and it can't fill it at all. So now you were given the long, you see this, if you're trained to read price action, man, you're licking your lips because you can see this is the easy money. And this fair value gap from here, that's a 50 handle opportunity. That is bread and butter. This forms every single day, multiple times a day. Maybe it's not going to be clean every day, which we use the economic calendar. There's a lot of tools we use to determine what are going to be the cleaner days. But these same things are happening every single day. And once you understand these components, you can see how it's easy to frame setups. You're not worried about, man, where's my next trade going to be? Or, oh, man, I didn't trade it all today. I'm not thinking, oh, shit, man, I missed this setup yesterday. I missed the setup today. I didn't trade it. Man, I need to do something different on my trade. You don't think that because you see these things repeat. You know you have fresh bread whenever you want it. And it's understanding these things that give you those opportunities. And then we see the market trades higher. We were looking, or generally we look for consequent encroachment or 50% here of the gap. But guess what? We don't need that, right? From when this trade was called out to you guys here to here, that gives over 85 handles. So within that, you need to find a model or a framework that frames what you're looking for. Maybe you're using an inversion fair value gap. I know many of you guys trade the inversion gap. Well, here it is. Or just the traditional fair value gap, or a breaker, right? A order block, right? Whatever level makes the most sense to you, right? Down close candle here. You buy the down close candle, bullish order block expands higher. So again, they all work when these components are behind it. So don't get caught up in the entry. Don't think, oh, well, I just need a new entry model, and that's why I'm not seeing consistency. It's just learning how to read price action at a higher level. Because if you can read price action like this, you can buy anything and make money. The entry is the least important thing once you know what you're looking for. So with that, I hope this one was insightful for you guys in framing setup, seeing how these things are framed consistently, and how you guys can absolutely do the same with just the free information we're giving out as well, not even needing paid information as well. So with that, do you guys have any questions for me before we keep it moving? And as always, I know Not all you guys are able to make it here real time. For those of you guys that are in the community, it will be recorded for you guys to be able to review at your convenience. iPhone. I'm saying iPhone because it doesn't say your name. It just says iPhone. I like to address people by their name usually, but iPhone, how do we anticipate profiles where London makes the higher low of the day? Thank you, sir. Excellent question. So the way we understand higher low of the day, one of the reasons why I always teach you have a benefit trading the New York session is because we have the benefit of seeing what London did. So if we can see London's already made a low, then we can trust New York's just going to be a continuation higher. If London consolidates, which it did, like going back to this example here when New York made the low of the day. All right, what did London do? London stayed in a range. So when London stays in a range, we can anticipate New York making the higher low of the day. And those are very simple protocols that we look for to determine the daily range and daily profiles based off what London did. So in my opinion, you have a built-in advantage trading the New York session because we can already see what London did. And we can see, okay, did it consolidate? All right, expect New York to make the higher low of the day. Did London already drop down, make a low, expand? Okay, well then New York's just going to give an optimal trade entry for a discount to continue higher. So in my opinion, you're better off watching what London does, and it'll give you immense insight for the New York session. But how do we anticipate daily profiles? That would be much more advanced because to actually anticipate what London's going to do, you actually have to understand the weekly range, right? Because where are we at in the weekly range? Did we already make a Tuesday low of the week? Because if we already made a Tuesday low of the week, then the rest of the days are just going to be expansion. So we're going to look for open, low, high, close, low of the day in London. So it depends on a few factors to predict that. But what I just gave you is an easy way to determine what New York should do based off London session characteristics. Benjamin, very helpful. Thank you, Dylan. I had settlement toggled and drew my daily fair value gap incorrectly given yesterday. My daily bias for today was bullish until we never reached consequent encroachment of the RTH, but it took me too long to switch my bias. That's a great learning opportunity, Benjamin, where we're still carving out our consistency. These opportunities are learning opportunities for us. So, we missed it today, but if we journal it, we make the most out of that learning opportunity, then we'll have it right for the next time. And I'm a big believer in that because if we're able to not get the same scar twice, not make the same mistake twice, what does that look like? Well, journaling, if we make a mistake, hey, sometimes maybe I forgot to have that daily level on as well. It happens. We're human. But then the way we train our brain to see it is we go in and say, you know what? Had I had this information on my chart, it would have given me more insight. And this was a great opportunity to reinforce why these levels should be on my chart. So then what happens when you learn that today in the session? You review it again the day after the session in positive words. And then on the weekend, you read it again. You're coaching yourself in a positive way, and you're going to get to your results and success so much quicker by doing those things. So it's absolutely normal for that to happen, to take too long to switch your bias. But over time, you're learning the components that allow us to switch our bias. Because as you mentioned beautifully, well, what does it tell us if the market can't even reach to consequent encroachment of that gap? We look for it, but what happens if it can't reach it? Well, what I already teach about gap theory, if we're looking at a gap, we want to see it do what? Get above it, use it as support, and expand higher. But if we can't even get to consequent encroachment or mid-gap, that's telling you it's very weak. So those are things that allow us to then pivot and then look for a bearish PM session. If we're looking for a bearish PM session, what's it going to deliver into? Bada beam, bada bam, clustered new week opening gaps. Great question, Benjamin. Helpful for everyone. Anthony, thank you. My absolute pleasure, brother. Appreciate you joining us. All right, so you guys are going to let me off easy today. Any questions? Any more questions? Maybe need to plan my schedule better and do it a bit later. I know many folks are working, running businesses, but we always do have the recording up. But I do like to give you guys the opportunity to get in here and ask any questions you guys may have. And something neat, if you look at the first fair value gap here from the session today, you extend it through. Look at how it gives you a nice setup here in the PM and rolls right over again into the new week opening gap. So if you know this is the draw on liquidity, and you can look to frame your short setups into the discount new week opening gap using this level, extending it through the entire day. And you can see I can't get above that. Gap theory would tell you we're bearish here because it can't get above it and it sells off quickly. And then they leave what equal lows here, here, and here. Those equal lows sell the idea of support. And they rip it down into, again, the new week opening gaps where they're clustered. So with that, guys, I don't see any more questions. That's going to be it for me. Hope this one was insightful for you guys. Have a beautiful rest of your day. And I will see you guys on the next one. Take care. Hope the insights that were given in the free side of the community is helpful to you guys. And take care. I'll see you guys on the next one. Bye, guys.